you're first.
And you're our lead off, so we'll be introducing you momentarily.
Okay, now we have to turn this thing on. And where's the on button?
Test. There you go.
Good morning, everyone. I'd like to welcome you to the Columbus area membership headquarters. Columbus Realtors, our new logo. And our class this morning, the short sale and REO panel, facts and expert advice from those who know. My name is Lori Molnar. I'm a member of the Residential Education Committee, and I will be here to address any problems we might have in the room and to give you your continuing education instructions. First of all, a couple of housekeeping items. The restrooms are located on the first floor down the hall on the left for those of you who've never been here. We will have a 10-minute break around 10:30. You are responsible to stay till the class ends at 12:15, according to the rules and regulations from the Ohio Division of Real Estate. Actually, our break is 10 to 15 minutes, depending on how our instructor feels we need to address the break. Officially ends at 12:15. You're okay with 15 minutes? 5 minutes. There will be a long line at the restroom.
To have so much power.
Okay. Each of you at check-in this morning should have received your continuing education form, which also serves as your evaluation form. As a member of the Education Committee, I can assure you that we read all the evaluations and we determine the needs of our members as to classes and future classes and instructors. Fill the form out entirely, please. Completion of the bottom portion of the form is only optional, but is the important part for your continuing ed, and that's the only record we have of your attendance. Each of you must hand in your own form. You will not be able to hand in a form for someone else. We ask that you turn off all cell phones or put them in silent mode during the class, as interruptions are disturbing to everyone. If anyone is unable to hear the instructors during the class, or the room temperature needs adjustment, or there's some special need, please let me know so that we can correct that during the class. I would like now to introduce our lead moderator, who will introduce each member of the panel as they come up. Alec Haggerty, with Knowledge Sponge Seminars, specializes in meaningful, relevant, fun, continuing education and training. A licensed broker for over 28 years, Alec now spends at least half of his time educating and training real estate licensees. Alec has taught well over 15,000 hours of all 4 topics of Ohio's required pre-license courses, post-sales and post-broker courses, as well as approved continuing education and training courses throughout Ohio and nationally. He is also an instructor on the faculty of the Ohio Association of Realtors, the Real Estate Buyers Agent Council, and the National Association of Real Estate Consultants. Alec is now an associate of RealtyU. In 1986, he was his local board Salesperson of the Year, and in 1994, Broker of the Year. In 97, Alex was honored as the Ohio Instructor of the Year by the OAR. In 1999, he was awarded the prestigious DREI, Distinguished Real Estate Instructor designation by the National Association Educators Association. In addition, Alex has received ABR, ABRM, CCREC, CRB, and SRES, a lot of alphabet there, designations. Alex's personal mission is to help realtors attain a higher level of professionalism by providing the best in up-to-date, relevant, meaningful, and entertaining education and training. Please welcome Alec Haggerty.
Thank you. Thank you very much. Good morning, everybody. Actually, we'll leave this up here for the others. You have the opportunity for very few dollars to attend this morning. Didn't cost you much, did it?
No.
You were happy to write the check this time, weren't you?
Yes.
So the origin of how this is able to be cost effective for you all is that your board reached out to NAR several years back when NAR made some funds available for public outreach programs to handle this problem we've been through for going on 7 years now or something like that. And what we put together way back then was an outreach program. In fact, a couple of people on our panel this morning were a part of that. And our goal at that time was to reach out to the public in the area around Columbus and say, if you've got problems paying your mortgage, if you've lost your job and you don't know what to do now with making your payments and all of these issues, then please come and we'll have a panel for you and we'll help you. Well, we did 2 of those programs, and Layden, I think you'd agree, we were disappointed. Yeah. But with the attendance, we were disappointed with the attendance from the public. But actually, when you think about it, who wants to show up and admit, I'm behind on my mortgage payments? So that part of it was a learning lesson for us. There were funds left over from that grant from NAR, and your board decided to invest that in this morning. So what we've done is, for the most part, we've recreated some of the panel that was utilized for the outreach of the public. But more importantly, we said, okay, who can we bring here to help you with the issues of the day? In other words, what are the changes coming? What's been going on? We've had a national mortgage settlement. We're going to hear about that. We've got some updates on some of the HAFA programs and things like that. And so I'm not going to do a lot of talking. I'm going to turn us over as fast as I can to these folks up here that have a lot of great things to share with us. And leading us off today is a fellow from the Attorney General's office, Mike DeWine's office, Matt Lamke, who has been with the Attorney General's office since 1997. He's currently the Mortgage Foreclosure Counsel to the Attorney General, assigned to monitoring committee overseeing the new mortgage servicing standards and distributing $93 million in demolition and programmatic grants. He's also served with the executive agencies, Court of Claims, Employment Law, Capital Crimes, and Major Appeals Group. And he's the coordinator of the Attorney General's Patriot Pro Bono program, where he educates volunteers. And it goes on and on and on. Who wants to hear from Matthew? Let's give him a round. I'll fire you up here.
Thank you. You can hear me from this far away? If I actually stand up straight, can you hear me? Yeah. Okay, great.
Forward, back.
Oh, perfect.
To move your slides.
So the Attorney General was successful in participating in the national mortgage settlement. 49 states did. Oklahoma was the only one that did not. Our biggest hook in the settlement with the 5 largest servicers was that we verified robo-signing. The filing of an affidavit without verifying the facts within the affidavit, or filing a false affidavit with your judicial and non-judicial foreclosure states. So as such, I was hoping to be called robo-counsel, but instead they gave me mortgage foreclosure counsel. So we announced this settlement in February of last year, $25 billion, and we partnered with the federal regulatory bodies as well as all the other states. And it only applies to the largest 5 at that time. GMAC is no longer in business, in the mortgage business. Ocwen purchased their portfolio, so Ocwen is now the 5th largest. And of course, we are pursuing Ocwen. We are pursuing the next group of, it was 12 at the time we started our negotiations with the next group, but based on bankruptcies and mergers, it's down to about 9. And so we're trying to bring all of the servicers under the same standards. So our immediate goals were provide relief to homeowners in economic hardship, enact new mortgage servicing standards, the Consumer Sales UDAP, Unfair Deceptive Acts and Practices type standards, obtain compliance with state foreclosure laws, and obtain a penalty from the servicers for their bad acts and practices. Whatever your opinion is of strategic defaults or walkaways, the banks owned up to $25 billion in liability. So not that there wasn't fault on one hand or the other, but we have documented unfair practices amounting to $25 billion. It's the largest consumer protection settlement in U.S. history. The breakdown of the relief, and I'm quickly going through these slides so we can get to some of the servicing standards for you. $17 billion in loan modification relief. That's refinancing and loan mods. Oh, I'm sorry, that's just loan mods. $3 billion in refinancing for underwater borrowers. $4.25 payments to the states, and we'll get into that in a little bit, and $750 million payment to the feds. Ohio's breakdown. Ohio borrowers directly received $102 million in loan modifications. That can be either principal reduction, first or second lien, forgiveness or forbearance. It's a waterfall effect, what is best applicable in their situation. Refinancing only applied to borrowers that were current in their mortgage, but were the equity in their house did not exceed their mortgage, and so they were able to take advantage of today's low interest rates under this refinance requirement. Ohio borrowers were to receive almost $45 million in a direct cash payment. We actually received almost $49 million because of the way they calculated it, and it was to our benefit, so I did not object to it. And the Attorney General, Mike DeWine, directly received $93 million. So going through those lists, under the consumer relief, the loan modification obligation, here's how the 5 servicers performed. Some of the relief, this particular relief, depended if the bank owned and serviced the mortgage. Other relief, it only depends if the bank services the mortgage. And there are numerous other programs out there where they'll talk to their securitized trust or talk to their investor about allowing for a modification. And they're still doing so even though they've satisfied all of their relief obligations. So on average, Ohio borrowers obtained a $38,000 reduction in their mortgage over the life of the mortgage based on these loan modifications. These are unaudited numbers. They're self-reported by the servicers. We're in the process over the next few months auditing these numbers. Under the refinancing relief, on average, Ohio borrowers received a 3% reduction in their interest rate by refinancing with the servicers. Do we have no pointer? No pointer on this?
Yes, it's right on the top, the red.
On the top. Okay. Our biggest concern is right here is that 4,800 offers went out and only half of those offers were accepted. And typically you would think of borrowers who are going through loan modifications are in a very emotional state, have some kind of economic hardship, medical hardship facing them, and they're getting bombarded and they might be a little shell-shocked, and that's why they may not believe the offer they may believe it is too good to be true. But refinancing offers only went out to borrowers who are current in their mortgage. So we're just trying to figure out why they're not accepting these solid offers. And on average, again, it's a 3% interest rate reduction. So maybe they're moving, maybe they were inquiring because of a need to get out from under it and move. Who knows what's going on. There were a lot of short sales, so they could have pursued that option instead as well. Yes, unaudited, self-reported numbers. We presume they'll be very accurate because if they're not, they will be penalized for it. Yeah, but not audited yet. Under the cash payment, there were 55,000 foreclosures between 2008 and 2011, and that is a completed foreclosure, not just a filing. And Ohio borrowers submitted claims for 32,000 of those foreclosures, so 59% return rate, which exceeded the national average by about 10%. That's why Ohio borrowers received a higher average payment than many of the other states. So the total payment comes to $48 million, and the individual payment to a foreclosed borrower is $1,480. And those checks went out in the middle of June. There are some issues where people are on the deed, not the note, or it's a divorce situation, and the banks or our claims administrator didn't have the Social Security number to issue a W-9. So there were some delays in checks that way, and that process is being worked through right now. We have been waiting almost a year for the IRS to get back to us on whether or not this is a taxable payment or not. And so out of an abundance of caution, we have to issue the W-9s, but they may be rescinded. There is a group of 30,000 borrowers that were foreclosed on nationally that were not notified of this settlement. So the exact amount of funds were reserved for them, and we're going through a separate process to notify them. So if you can imagine, the banks did not track 30,000 borrowers, and the fact that they foreclosed on them. And then the Attorney General received $93 million, and he said, what do I do with it? We looked at what other states were doing. Obviously, a lot of interest groups came into the office to propose various ideas. You know, California and Arizona, they took all of their money, put it in their black hole of a operating deficit. The AG, with his relationship with the legislature, the fact that Ohio's economy was turning around, was able to keep it for a program and devoted it towards a residential demolition program. Ohio was the 13th largest recipient of funds under the settlement, and no state that received more money than Ohio has devoted 100% of their direct payment to consumer relief type activities. And the AG saw that those that were foreclosed on their home received a direct payment, and they did not waive any rights or actions against the servicers. So if they believe there was an improper foreclosure, they can still sue them for 100% of their damages. Ohio is a judicial foreclosure state, so a judge said everything was proper. So you would actually have to look behind all the documents to find some kind of an abuse. And those that are in their homes going through the foreclosure process are getting loan mods and refinances, but he viewed those that were in their homes with other servicers paying their mortgage or have paid off their mortgage as also being victims of the mortgage foreclosure crisis, because they saw the value of their homes drop despite doing everything right. And so he viewed getting rid of blighted properties. That is, copper's been torn out, metal siding has been torn off the sides of the house. These blighted properties as a drain on city resources, police, fire, code enforcement, water, sewer, all these resources going to a single structure that is returning nothing back to the city and doing nothing for the neighbors. When you actually see these properties at night, it's like a black hole. All you see is darkness. You know, no light is coming through. And so if you get rid of these properties in the first instance, then it allows for other steps. What do you want to do with it? We've asked people to have a strategic plan. We've asked them to consider economic development down the road, or whatever they want to do. But the first step is to get them down, and then we can go from there. And so he devoted all of his funds to demolishing these structures. And my personal goal in designing this program is that we will be able to knock down 10,000 structures across Ohio by the end of the program. Yes?
Do you have a breakdown of the distribution by county of the monies?
I do. The smallest county, I believe, received 40,000. The largest county received 11 million.
Which ones were they? Do you know that?
I know Cuyahoga was the largest. And we did it based on the percentage of foreclosure filings as reported to the Supreme Court. So over that same 4-year period. So it was a very objective formula, and in my opinion reasonable, only because we haven't received any complaints. over how we divided up the funds.
Where did Columbus fall?
Second, 7 million. Yeah. And the Franklin County Land Bank is just getting started, so they're a little slow, but the City of Columbus has been submitting reimbursements and have submitted over $1 million in reimbursements that we've paid. We've already documented $28 million worth of demolitions, knocked down 3,664 units. We define a unit as a separate address. So you could have a duplex being 2 units instead of 1, at an average cost of $7,600 for a demolition. Whereas if you did a rehabilitation, you're looking at $60,000 to $80,000. And we were told by others that do this, I'm a lawyer, I don't do construction, that if you renovate the property and don't get rid of the blight, your renovated property is going to turn into blight in 2 years, because no one's going to want to stay there. They're going to leave, all the copper is going to be ripped off, all the siding is going to be ripped out, and then you're going to have a second blighted property. So again, justification, you may not agree with demolition, but that was where the Attorney General decided to go, and I'm trying to give you the reasons why, based on the experiences of others. Yes?
Experience from others myself, I've had the copper torn out, but all you did is replace it with plastic.
Plastic? Okay. Okay. Good. Yes, question?
What criteria did you use to decide what units and what houses you wanted to demolish?
We are leaving that up to the local counties. Every house in every county is eligible for demolition. So we did not have census tract data restrictions that the federal programs had. We did not have Davis-Bacon. We did not have historic clearance restrictions. So there are only certain ways in which a government can get control of a property. That's nuisance abatement, condemnation, delinquent tax foreclosure, or voluntary consent. Please tear down my house for me. So under condemnation, you have to have a certain standard of a blighted structure in order to demolish it. Yeah. In a lot of cases, the fire department and the health department are identifying the houses for the cities to knock down. Yes?
So then, is there some sort of residual where the property owner has to hold on to that vacant lot for a certain amount of time without it being sold before they have to reinstate the money back to the program?
We don't have any restrictions like that. We encourage cities and counties to put a lien on the property for the cost of the demolition, only because these are one-time funds, and we think we're only going to address 10% of the problem in Ohio. There's an estimated 100,000 vacant property problem in Ohio. Many counties are not doing liens, and so the homeowner may get a free demolition. And that is determined locally. Did I answer your question, or? Okay. In every case except for a delinquent tax foreclosure, the local government only gets control. They don't get ownership. And in 99% of the cases, local governments do not want ownership, because they have a vacant land that they have to maintain, and after a period of time, a year or two, they have to start paying their own property taxes. Unless it's being used for a government purpose, they have to pay property taxes on it. So they don't want that ownership. So we had imposed 304 new servicing standards, and we're testing them under 29 different metrics or tests. And as you may have seen in the paper, New York Attorney General and others, they are failing some of these metrics, forced place insurance being the largest one. But I am on the monitoring committee for Ohio. There's 15 states on the monitoring committee. And I am assured that they are getting into compliance. So we have a standard, and we have a way to enforce that standard. They are self-reporting these failures to us, and they're self-reporting how they're going to correct it. So the system is working. It's not immediate. I'm not denying that there aren't still problems with these servicers, but we are obtaining results from these standards. The forced place insurance, the issue is they have 15 days to remove insurance after the borrower shows proof of insurance, and they're not removing it within 15 days. In one case, it was a systemic failure. Their third-party Assurant is their third-party forced place insurance provider. just was never getting the letter out within 15 days. So that bank, that servicer, had to go through every loan in order to determine restitution to the borrowers. Whereas if it's not a systemic violation, you would reimburse those borrowers that you were able to identify or reported the violation to you. So the process is working. There are escalations. There are ways of enforcing it outside of the courts, and we're achieving that without having to go back to the court. But these are some of the areas that we're looking at. These servicing standards are valid for 3.5 years, and it's presumed that in the meantime, the CFPB, Consumer Finance Protection Bureau, has enacted many standards, and those standards are going to go into effect January 1 of next year. And in many cases, while they achieved the same goals, their standards are less than what was achieved in the mortgage settlement. So take that for what it is. Under loss mitigation options, and I'm just highlighting a few of the standards that you might be most interested in. Please ask any questions you have about any of the other ones. But the servicer is required to notify the borrowers of available loss mitigation prior to commencing foreclosure. So if you get a delinquency prior to filing, they need to solicit the borrower to see what loss mitigation options they'd be interested in or eligible for. If the borrower submits a complete loan modification application, and we have issues with what constitutes complete, the servicer cannot file for foreclosure. If they've already filed for foreclosure, the servicer cannot go to a sheriff's sale or go to judgment. If they've already gotten judgment and a complete application is on file, they cannot go to sheriff's sale. So there are stops, dual track restrictions, which I'll get to on the next slide, on protecting the borrowers so that the servicer has time to evaluate the application, and on the borrower side, time to get the documents in. But we are talking 5-day turnarounds and 30-day review periods. So we're talking what should be a quick process. So dual track restrictions, that's kind of what I went over, the time frame before foreclosure, before judgment, and before sheriff's sale in Ohio. We're all familiar with dual tracking, the simultaneous pursuit of a loan modification and negotiation while also the bank pursuing foreclosure at the same time. And oftentimes the modification negotiation was not happening soon enough and the foreclosure judgment came, which just confused the borrowers. They thought they were going to be safe. So our next biggest issue are the servicers notifying the borrowers of known deficiencies within 5 business days of receipt of the application. The issue we're finding with the servicers is that they have a standard form. These are the documents I need. They get that form in. Sometimes that standard form document, the documents required on that standard form are not submitted, and that generates another 5-day letter. But oftentimes they'll get every document they need on that form, and then they have to request other documents not listed on that form. And this is before going to underwriting. Because on the form you've got your self-employeds, you've got your pay stub, your W-2 people, and you've got third-party income going on. And so if someone is just a wage earner, they will submit their documents, but on their W-2, on their tax returns, it'll show rental income. Well, then you need proof of the rental income that's not on that standard form. So that's a typical reason why you would need more documents, even before going to underwriting. Once it goes to underwriting, they too may determine that there are additional documents, proof of income needed that was not requested on the initial form. So you will see banks sending letters saying, we have everything we need, and then 2 days later, underwriting say, we don't have everything we need. It's causing confusion. So we are working with the banks on their language in their letters, in addition to identifying the process that's going on. In was it Wells Fargo's case, they told us they can generate a approval of a loan modification application 3 days after receiving the completed application. They don't need the 30 days to do it. And in 60 to 70% of their cases, they can do that. They find certain borrowers, again, it's an emotional time. They are not hearing what is needed, and they're finding a certain segment of the population just wants to game the system and never submit what is truly needed. They'll just submit one thing instead of the other, or submit something different than what was requested, just to delay the ultimate foreclosure period. That is their self-report. That's nothing we verified on their behalf. We required a single point. Yes. Yes. There's an expedited review of the application. If it's already gone to judgment, between 37 and 15 prior to the sheriff's sale, that window of time, if a completed application is put on. So judgment has been obtained, the homeowner, the borrower has gotten notice of that judgment. They may be serious about getting a loan modification at that point. So there's a window of time to get that application in. Now, I've had a borrower call me 2 days before sheriff's sale, and I call up the bank. I'm the Ohio's escalation point of contact, and I've dealt with a Cincinnati realtor more often than not on these issues. Call up, and I bypass the SPOC. I go to a vice presidential response unit and say, they want to know if you can delay the sheriff's sale, and it's 2 days away. And I have gotten a response in an hour saying yes or no. At least we get an answer, which is the key for me. And in one case, they said, in Chase's case, they said, yes, we will delay the sheriff's sale, and they pulled it from the docket. In another case, they said, no, they haven't paid on this loan for 5 years. We're going to foreclosure. So it just depends on the circumstances. Good. The SPOC, Bank of America just told me in New York that they were resistant. They thought it was going to be horrible. It's actually worked out really well to have a SPOC and team members supporting one person staying with the borrower from delinquency through foreclosure, through the loan modification process to the sale, explaining throughout what's going on. And they have found tremendous benefit from the SPOC. If Ocwen gets brought into the fold, the issue with the SPOC is that they set up appointments. Each SPOC has on the servicers, between 75 and 100 borrowers that they're dealing with on any given day. That's their portfolio of delinquent borrowers they're dealing with. And if you can't make that appointment, or if you don't get all of your issues resolved in that 30-minute appointment window, they say, I have my next appointment, goodbye, we'll set up another appointment. So that can be an issue with the SPOC as well, that it was unforeseen when we negotiated this. Short sales. The servicer must confirm they received the request for a short sale. Confirmation must include the servicer's requirements for a short sale, and that the servicer may demand a deficiency payment. They need to identify that up front. Servicers must notify the borrower of any missing documents within 30 days. And the decision must be sent to the borrower within 30 days of a completed application, and any denial must state the reasons why. So again, quick process on a short sale application. And if the bank waives the deficiency payment, they can't sell it. Oh, I guess I was a slide short. So there's additional protections for military personnel. Essentially, enforce the SCRA, the Service Members Civil Relief Act. But in addition to that, service members don't require delinquency to obtain the same protections. Forced place insurance. I'm kind of running through this now because I'm almost out of time. We talked about earlier. And enforcement, there's a monitoring committee, there's 15 states, plus 2 federal entities. Ohio is on that monitoring committee. So state attorney generals can enforce, the state regulators in Ohio, Division of Financial Institutions. We can bring our own action in court to enforce it. The monitor, Joe Smith, can bring that action. A individual state can bring a complaint to the monitoring committee like New York just did, and within 21 days after filing that complaint, they can file a complaint against, an individual complaint against the servicers. New York, we rejected their complaint because we believed the escalation process was working and we did not need to go to court to enforce the terms. They can file starting Thursday, and we were informed from them that they are not filing on Thursday, but they may file in the near future. So we get our complaints through consumer complaints, self-reporting it through attorneys, realtors. We'll meet with the monitoring committee, and we can get equitable or civil penalties for violations of the National Mortgage Settlement. And if borrowers have consumer complaints, Ohio receives 30,000 a year. I just talked to my counterpart in Texas, and they receive the same amount, 30,000 complaints in Texas a year, which is shocking since they're so much larger. But these are the areas, these are the regulators over the state and national banks and the servicers, if they have a complaint. Yes?
One piece of this that you might be able to fix now if the banks are actually talking to you. For example, we are in Franklinton, we live in Franklinton, we own property in Franklinton, we have good credit, we have good income. On my street, there are 4 houses in a row owned by members of the same family. Average mortgage $20,000, and they are walking away. I would take over those 4 houses at the $20,000. The bank wouldn't need to lose a dime, my credit check would be easy. But by the time it goes through the existing process, those houses won't be worth buying, and the city will end up demolishing them. Is there a way to short circuit that now? Are the banks ready to talk about stuff like that?
They are, but I'm finding that the banks are looking at bulk purchases, not individual sales, is what I'm finding.
And 4 isn't bulk enough.
Right.
And by the time they get their bulk purchase, these houses will be trashed.
And by the time and the bulk purchaser is not interested in upkeep of the individual properties either, which is a problem for us. Right, right. Sorry. And, yes, question in the back? No?
Okay, I got a couple. What are you doing about the rest that Victor and one of our own, the other lenders that they had? And then the other question would be, and you may have touched on it, loan assignment. And when you look at the MERS loan assignment, the end person signing as whatever, secretary or vice president, assigned by MERS, is an employee of the end recipient. Let me say, if Wells transfers servicing to U.S. Bank, which tended to happen before this active, and you find that the person signing is actually an employee of U.S. Bank, what are you doing about those things?
I haven't seen that particular complaint yet. We are looking at MERS. Several states have sued and lost on summary judgment, meaning they had no claim against MERS based on their statutory scheme. MERS only liability has come in a state where they found that they the state requires the filing, the recording of the note. If the state does not, and Ohio does not, then there has been no other liability against MERS. As far as assigning, there is no restriction on a bank assigning a mortgage that they have. However, they have informed us, and it's in the settlement, that the benefit, the loan modification application, transfers with the assignment. I have not yet seen an assignment where, I've not gotten the feedback yet where the assignment has resulted in a loan modification for the borrower, but I have not received complaints yet that it hasn't happened.
And what
Other servicers? Yeah, as I said in the beginning, I don't know if you were here, a couple people walked in. We are pursuing the next group of mortgage servicers in litigation and negotiation. We should be able to announce 2 next month. I'm finalizing those right now. And the CFPB is coming up with national standards. So it won't matter if you're under our settlement agreement or not. There'll be a national standard of servicing standard under the rules that they're promulgating. These are additional resources, and we'll be introducing Save the Dream next, which is one of those resources.
Let's give a hand for Matt. Thank you, Matt. Matt will be available, as all our presenters will be available later for, let's see if I can get, there we go, I got it, yay. Next up, we have a couple of guest panel members from the Ohio Housing Finance Agency to help us understand some of the current programs available or opportunities available for our consumers. So we have Daphne Hawk, who's been a licensed agent in Ohio for over 17 years, has served as sales trainer, productivity coach, team leader for some of Central Ohio's largest real estate brokerages, as well as an adjunct faculty member for Hondros College and the Ohio Association of Realtors. She holds several designations, and along with her, we have Tanya Bruner. And Tanya is the Assistant Operations Manager for the Ohio Housing Finance Agency in the Office of Home Ownership, and has served as the Consumer Advocacy Manager at OFA, and has been a strong advocate for borrowers who have been unable to reach agreements with their servicers. Her ongoing work developing and implementing an escalation process for modifications has been recognized by many partners in the Save the Dream initiative, including the Ohio Departments of Commerce and Development and the Ohio Attorney General's Office, as well as elected officials at both the state and federal level. And in 2010, she coordinated training sessions with housing counselors throughout the state in conjunction with Legal Aid Services and the Ohio Department of Job and Family Services. So let's welcome both Tanya and Daphne. I don't know who's going to speak first. There's the clicker.
Thank you very much.
Thank you.
Good morning. Can everyone hear me all right? Okay. So I would like to introduce Save the Dream Ohio to you. How many people have heard of Save the Dream before? Do you have any clients that have accessed the program? Wow, just a couple. So maybe that's something that we can work on. This is an excellent tool for the realtors to help you buy enough time to potentially sell the home, also to help your borrower get money for transition assistance. And right now the transition assistance amount is up to $7,500. That could certainly make the transition out of a home after a short sale much more palatable to your homeowners. So Save the Dream Ohio is Ohio's state foreclosure prevention program. It's funded with hardest hit funds dollars, which are TARP funds. They flow from U.S. Treasury through the Troubled Asset Relief Program. It's administered by OFA through the U.S. Department of Treasury. Ohio's total allocation came in 3 different amounts to the total of $570.4 million. Ohio is one of 18 states, along with DC, that are participating in this program. And Ohio has consistently been in the top 3 to 5 as far as success for the program and dollars out the door. To date, we have helped over 11,000 Ohio homeowners either save their home or buy them some time so they can transition to their next step. So this gives you a timeline of how it started. There were initial discussions. Ohio was not one of the first 5 states that started with the hardest hit funds, but thanks to the Attorney General's office, several legislative offices, we were able to pull that money into Ohio. And because of a successful implementation of the program, we received 2 more influxes of the funds, so that's where we get the $570.4 million. We have changed the program to suit Ohio's needs as the needs have changed for the homeowners. So our last update was February of 2012, where we expanded the program, and that includes expanding the look-back period. So we felt that was very instrumental in helping save more homes, because we had a 12-month look back. Now it's been expanded to 36 months. So what that means for you is if you are getting ready to list a house and they perhaps were unemployed 2 years ago but have exhausted benefits, they may be eligible for the program through the transition portion of the program. So the application process has been streamlined. We require far less documents than we did when this started. And I'm just going to lightly go over the application process and then go into the individual programs. And if at any time anyone has any questions, please feel free to stop me and raise your hand. There's an initial pre-screening tool, which is new since February of 2012, where a homeowner can go online, do it in the privacy of their own home, and see if they may be eligible for any one of the programs through Save the Dream Ohio. They may also call in and have us go through the pre-screening tool with them over the phone. We can actually take the entire application over the phone. After that portion is completed, they will be referred to a HUD-approved housing counseling agency. This is a primary function, and one of the reasons why we've had such success with the program. This is completely free to your homeowners. This costs them nothing. So they are referred to a HUD-approved housing counseling agency for either a face-to-face meeting or either a telephone interview, where if they've got additional questions, they can speak to the experts on the other end and get some budget counseling moving forward. So it also allows them to access additional resources. So after the counseling, the homeowner is required to sign the application and also to submit the supporting documents to the housing counselor. The housing counselor will go over the package and then upload it and submit it to OFA for approval. It goes through an underwriting process. If anything's missing, then the homeowner is notified of what's still required, and then they submit the new documentation through the housing counselor, and the process moves forward. If OFA approves, we still depend on approval from the servicer. So the servicer, for any reason, has the right to accept or reject the application. So just because OFA approved does not mean that the servicer will necessarily approve. Something to watch out for: a lot of homeowners will use a Chapter 13 or a Chapter 7. They usually have other problems, other financial problems beyond just the home. If they are in an active 7 or any time during the period of an active 13, we can't help them until they're completed. So if it's a 7, it's during the period of the initial filing all the way to the discharge. On a 13, it can be anywhere from the initial filing all the way up to the end at 5 years. So when it's sent to the servicer, they have the ability to accept or reject. We find that most servicers will approve the assistance unless there are other circumstances. If there was a prior bankruptcy on the file, sometimes they don't have up-to-date records. That could cause them to object. They could also object to the type of assistance. If that borrower had been delinquent multiple times and they were able to reinstate the mortgage in between, they may look at that as just a systemic problem. Maybe the numbers don't work, but in most cases they do approve, because this program will allow the loan to be completely reinstated. So they're made whole on the back end, and there's an option, if the homeowner qualifies, to have monthly mortgage payments, 100% of their mortgage payment made on their behalf directly to the servicer. So after the servicer approves, it goes back to OFA for final approval, and we also create the closing documents. There is a true closing. They either go to the title agency or a title representative comes to them. They execute documents, and there's a lien placed on the property. It is a non-recourse loan to the borrower at 0% interest with 0 payments. It's completely forgivable at the end of 5 years, 20% per year. So a year after the closing date, if they access $10,000, they're only going to be responsible for 80% of it, and so on until it actually clears completely out. If the home is taken through a foreclosure or through a short sale, OFA forgives the lien. It does not follow the borrower, it stays with the property. We also are more than happy to subordinate. Sometimes, and we've had several of these come through, several hundred, where the borrower will be in a delinquent state. They will access Save the Dream. We reinstate the loan and make maybe 12 payments for them. That puts them in a better position, and maybe a year after that, they're able to refi. So we are more than happy to go behind that and go behind that and subordinate. There were a few lenders that started to require that they pay that lien off, but we're happy to get on the phone and explain, this is a non-recourse loan to the borrower and there are no payments due. So normally they will let us subordinate. Please. Absolutely. We do not require that they sign again for the mortgage, so they do not have to affirm after the bankruptcy. We feel that that would be detrimental to the homeowner. Any other questions? So the closing happens and then funding occurs, and this can take anywhere from start to finish depending on how dedicated the borrower is to gathering the documents. It's far less than what's required for standard modifications. But it can take anywhere from start to finish 30 to 45 to maybe up to 90 days total. So the marketing outreach, and this just gives you an idea of how Save the Dream advertises. Right now, first quarter of 2013, we actually divided the state into 4 different quarters and started with Northern Ohio. Then we hit Southwest Ohio through television, radio, billboards, newspaper, online advertising, and now we've started to dip into movie theaters. And we've seen a substantial increase in our calls to the Save the Dream Ohio call center since we've added the movie theater advertising. And here are just the results as of the end of first quarter 2013. And again, I'm pleased to announce that we have eclipsed the 10,310 and now are well over 11,000 borrowers that have been helped. We also allow them to return for assistance. So depending on when they access the first time will depend on what available maximum benefit they have to them. So 85% of the borrowers earned less than $50,000. What we're seeing when this started, it was definitely an unemployment issue. Now it seems to be an underemployment issue. So they're back to work, they're working a full-time and potentially a full-time and a part-time, and they still are earning far less than they did 3 or 4 years ago. So the end of first quarter 2013, that just tells you the breakdown, and this is a good part to go into detail on the programs. We designed the program to fit a lot of different circumstances because this is not a one-size-fits-all problem. So what we did, we designed an RPA program, and what that is, that's a full reinstatement. So most of our borrowers will use at least 2 of the different programs. So the RPA is the reinstatement, and we require that the loan be fully reinstated. As of right now, the total benefit with one program only is a maximum of $25,000. Accessing 2 or more programs, the total is $35,000. So it's divided into 25 and 10. So normally they are behind a few months, maybe a year or 2, depending on the size of the delinquency. It's going to be a very different conversation if it's a $2,200 a month PITI payment versus if it's a $500 a month. So if you have borrowers that have the payments that are on the larger end, get them to Save the Dream Ohio just as quickly as possible so that we can stop that bleed on the back end. It will give them more benefit moving forward for the other programs. So the second largest would be the MPA, and that's the Monthly Payment Assistance Program. When Save the Dream Ohio launched, we required that the homeowners have some skin in the game and that they pay a portion of the payment according to their financial situation at that time. We did not find that to be very effective. It was very difficult for the servicers to post payments. There were draws coming out of homeowners' accounts when there shouldn't be from the master servicer. So we switched that over on one of our first changes to go to 100% monthly mortgage payment assistance. Even though they didn't have any skin in the game, and there was a lot of discussion with external and internal stakeholders, that gave that family the best chance to get back on their feet if they weren't making a portion of their mortgage payment. So if they were living on unemployment checks only, it would be very difficult for them even to put $200 or $300 towards the mortgage payment. So we felt that this put them in a better position moving forward and gave that family a chance to get back on their feet. The LEA program has not been as successful as we had hoped. That's the lien elimination. So we have, I think the highest one that we did for a $15,000 payoff was a $91,000 loan. So they actually forgave it. And that's going to really depend on how that it's backed, whether it's a government loan, whether it's a portfolio, it's in-house. So sometimes there's more flexibility depending on the circumstances or the history on the loan. That's all going to come into play too, but we do get those. Transition assistance, we have not received much traction on that, and that's something that I definitely wanted to push forward to our audience today. I think it's very important, and I'm not sure that everyone knows that's available. But we don't stand in the way. If Fannie or Freddie, if they're giving $1,500 to $3,000 to move, we are not opposed, neither is Treasury, to put another $7,500 towards it. The catch is we require them to waive the deficiency judgment. That's where we've received the pushback. So oftentimes in the short sale, they're not willing to waive the deficiency judgment. That's a requirement under this program. So if we help the borrower move to their next place, the house is left in broom-swept condition, we expect the servicer to then waive the deficiency judgment. They still could be taxed on the phantom income, but they can't come after them for the difference. This becomes complicated if they have first and seconds, and depending on what other type of tax liens are in the background as well. So we're running into some heavy opposition with some IRS tax liens. So these are all things that you want to keep in mind when you're looking at transition assistance. The cleanest and best would be first mortgage, no liens on the back end. Not always possible. If the first and second, say, are both with B of A, you've got a good shot at that because part of the funds can be used to extinguish the second. And then the MCA program, that is new since February. And within that, we have a recast option, which the servicers are working on how to figure out to gear their platforms up so they can accept our common data file and actually get them done. So when they're happening, and it's making a huge difference to the borrower. This is something that we're projecting we're going to have a lot of traction with moving forward. So what it is, if your borrower's behind maybe $10,000, that would leave them a balance of $15,000 to put towards the principal balance on the mortgage, and the servicer would then recast the loan. The interest rate stays the same, the term stays the same, but they re-amortize everything as is. So if you have a seasoned loan, this will be very beneficial to your borrower. Do I have any questions on recast at all? The homeowner retention assistance is another program that we just rolled out in February of this year. That allows for condo fees to be paid, taxes, if they're delinquent, not if they're a lien. If it's a lien, it's too far gone and we can't help. But if they're delinquent, we can help pay that. And it also will take care of some of the other ancillary things, the HOA fees, and potentially delinquent second mortgages as well. And here are some figures with results at the end of first quarter of 2013. So if you have any questions, please feel free to contact Stephanie Casey Pierce, our Housing Counseling Support Manager at OFA. Her email is usually the best way to reach her. She's an excellent resource to kind of help you get to the next step. If you have a homeowner that is interested in transition assistance, for us to be able to talk to you, there has to be a third-party authorization on file. So keep that in mind, and that can be turned in with the package to OFA. So are there any other questions? Please. They have to be out of it.
Tanya, could you repeat the question? Because I'm not sure all of us heard it.
Sure,
Thank you.
and please correct me if I misunderstood. You're asking how long after the bankruptcy or at what point during the bankruptcy would someone be eligible for SDO funds? They would be eligible as soon as they're not in an active bankruptcy. So the timeline's going to depend on their individual situation, the court dockets, et cetera. But what will happen is from the time that they file, our assistance has to stop, and unfortunately that's happened in a couple of cases. So they received the RPA, they received the reinstatement, and they were approved for 10 months of monthly mortgage payment assistance. They're in the middle of that assistance of having their mortgage completely paid each month, and then they file bankruptcy because the consumer debt, it's just been a crushing blow and it's a financial decision that they've made. Our assistance has to stop at that point. They can come back and file an appeal after it's finished and it's been completely discharged. On a Chapter 7, it's after the discharge date. So if they get discharged on a Tuesday, they can appeal on a Wednesday or put their initial application in on a Wednesday. As long as it's been discharged by the courts, we're free to assist. Okay, thank you. Please.
If the homeowner has a short sale offer in process,
Mm-hmm.
is it too late to apply for?
No, get to us as soon as possible. Best case scenario is that you apply prior to the short sale process, get them in the system and get them rolling. You run into a timing issue because after the offer is made, it's usually too late on our end. So you want to try to get there ahead of time before, when it's listed for short sale or prior to the offer coming is the best time to get to us.
Eligible for transition assistance?
They may be, depending on their situation. They have to have an eligible hardship. If they quit their job, that's not an eligible hardship. If they became unemployed or if they're underemployed, and there are formulas that we look at on our side. So if any of that's happened within a 36-month period, they may be eligible. A divorce is an eligible hardship. Also, we follow the IRS guidelines for hardships regarding medical expenses. So prior to 2013, the threshold's 7.5%. 2013 and moving forward, threshold is 10%. So if they've used 10% of their income towards medical expenses, that may be a valid hardship. The housing counselor will be the one that actually crunches the numbers and goes through that and determines initial eligibility.
What about the lien elimination? Is that available to somebody, or is that also before reinstatement?
Eligible hardship, yes. Mm-hmm. And we can do a lien elimination on just a second. If the first won't play ball, or we can go after that second. So the one of the things that I'm most hopeful for would definitely be the recast, because on a seasoned loan, if they owe $80,000 and we can put $25,000 towards it, that's huge. That's going to make a huge difference, and it's going to make them sustainable moving forward. The numbers have to make sense for that family to stay. Any other questions? Okay, thank you very much.
Thank you, Tanya. Thanks very much. I remember back to the 1980s when OFA was first somebody's idea, and then if I remember right, didn't the citizens have to vote for OFA to form? That was one of the best decisions Ohioans ever made. OFA has been nothing but a shining star to the consumers and our industry since the 1980s. So I'm very pleased that they've got even more programs than they started with. Next up, we have Layden Hale, and Layden serves as a senior housing counselor. Now, I don't know about you all, but doesn't he look good for a senior? I mean, really? Yeah, is that what it is? You know, I like older. It sounds so much better than old. Anyway, okay, so Layden's the senior housing counselor for Homeport Housing Advisory Center, and he provides counseling services to clients in need of assistance in saving their homes from foreclosure. These include budget reviews, financial education, negotiating with lenders, and in addition, he provides HECM reverse mortgage counseling to those folks, interested clients over 62, and he's available to attend various public speaking engagements, and he's got over 25 years in the industry, and let's welcome Layden. Let me get you fired up here.
Okay, thank you, Alex.
There we go.
There we go. Again, my name is Layden Hale, Senior Housing Counselor with Homeport. I'm here today, though, to talk to you guys about why you should send your clients to a HUD-certified counseling agency. Has anybody ever sold a house to somebody, you guys, and 2 or 3 years, 5, 10 years later, the client comes back to you and says, hey, I'm having problems keeping my home, what do I do? Have you guys ever received that? How many of you guys have actually sent your clients to HUD-certified counseling agencies? Large room, I see 2 or 3 hands coming up. So this is a good topic because why should you send your clients to a HUD-certified counseling agency? First and foremost, we're free. There are a lot of agencies out there that have developed over the last 5 to 6 years because of the foreclosure tsunami, if you will. But some of them charge, some of them don't. There are way too many people in organizations in the state of Ohio who are trying to keep your clients in their homes for free. So first of all, our services are free. Second, the HUD-certified counseling agencies have been around on average for, well, some of them have been here over 60 years. This is not, we're not organizations that have started within the last 4 or 5 years. On average, we're averaging 25 years in existence. So we've been around a while. We can help your clients understand their options. It seems like every 6 months there's a new program that comes out. I mean, there's HAMP, there's HAMP 1, there's HAMP 2, there's HAFA, there's HARP, you know, there's Ohio Save the Dream, there's Restoring Stability. There's a lot of options out there for your clients, but how do they know which ones are good for them? And so you come to a HUD-certified counseling agency because we're the experts. We stay up on all of these changes that come down the pike. And we can help your clients. A lot of times your clients are sent, go get that Ohio Save the Dream money. Go get that HAMP. But there are eligibility requirements for all of these programs. And these nice people have told you some of them. But we are there to actually tell your clients, based on your goal, based on your financial situation, based on your hardship, this one may be the best program for you. Again, you know, there are a lot of them out there, a lot of things to choose from, but again, you have to be eligible for them. Mortgage assistance funding may be available. Ohio Save the Dream is probably the best deal going. And I know when Tanya said, you know, how many people have you guys heard about it, that they can give you up to $35,000 per household to help keep you in your home. That's, I mean, and that's really, there's no other pot of money out there. You know, there were 4 or 5 years ago, certain organizations had money that they could help your clients with. Now, Ohio Save the Dream is the only thing going. So if you need financial assistance, it's a good program. Families who seek housing counseling are more likely to stay in their homes. Your clients have worked with the mortgage companies before. They've been working with them sometimes a year to 2 years, only to find out they put in an application, they get declined. What happens now? We'll start over again. Not to say that we can guarantee, we never guarantee that we can save, you know, your client's home. But I can tell you we're pretty doggone good at what we do. We have opportunities to talk to the mortgage companies. We negotiate on your client's behalf. But one of the biggest things one of the biggest roadblocks your clients have is the clients need to submit a complete application. I think Matt talked about complete applications before. What is a complete application? It continues to change. But the likelihood of them getting a successful outcome is greater if they submit a complete application. And when you come to a HUD-certified counseling agency, we help ensure that that application is complete before we submit. Okay? if you send your clients to a HUD certified counseling agency, the first thing we're going to do is find out what is their goal. And it's not a good thing to assume that every client that comes into your office wants to save their home. We ask the question, what is your goal? Do you want to save your home? Do you want to get rid of your home? Some people are they just get tired of going through it. They realize they can't save their homes anymore. I want to transition out of my home. So we find out what the goal is, and we work toward that goal. Depending on what they say the goal is, we work toward it. The easy part, or I should say the hard part, is not negotiating with the mortgage company. 3 or 4 years ago, 4 or 5 years ago, it might have been hard to negotiate with the mortgage company. The hard part of my job now is not negotiating with the mortgage company. The hard part of my job is taking a client who, because of their financial situation has changed, because of their hardship, they can no longer stay in their homes. Financially, it just won't work. And the hardest part of my job now is having to work with them to change their goal. Because if you financially cannot stay in your home, you have to consider transitioning out of your home. So, but we look at that. We look at the goal. Okay. Once we determine what the goal is, the next thing we're going to do is we're going to discuss options. Again, there's a lot of options out there for the clients. A lot of times they're being sent to go ask for this, go ask for that. But based on your goal, based on your financial situation, it kind of determines what your options are. First option that mortgage company would like to offer you a lot of times is a repayment plan. Maybe your client has gone through a hardship, but now they've worked through that hardship. Maybe I had a job loss and I lost income for a period of time, but now I'm back to work and actually I'm making more money than I made before. The repayment plan is where the mortgage company can say, okay, we'll accept your regular payment and we're going to accept an additional payment. Maybe a payment and a half, payment or 2 payments. But if you're financially able to do that, that might be the best option for the client. It's best for the client. It's best for the mortgage company. And you can get that turned around pretty quickly. If by chance the client's financial situation does not allow for a repayment plan, the next option would be a loan modification. A loan modification is where we're going to ask the mortgage company, can you modify or change that existing loan? When I say modify, maybe the client's $10,000 behind on their mortgage payment. Okay, they're actually in default. They're $10,000 behind on their mortgage payment, and so they have closed down that payment window. The mortgage company is no longer accepting payments from them. If we ask them for a loan modification, can we take that $10,000 and maybe roll it to the back end of the mortgage? While you're modifying that loan, because once they take the past due amount, roll it back into the mortgage, then the client is current. Then they will open up that payment window, start accepting payments again. But while you're modifying that payment, can you also make that payment more affordable? Maybe you've taken the past due amount, roll it back in, but now I also need an affordable payment. So maybe can you lower my interest rate from 6.5, 6.25 down to whatever the going rate is now, 4.25, 4.5?
Closer.
So can you modify it, my interest rate? Sometimes can you extend my term? So that loan modification is really a lot of times what the clients will need. And if they qualify for it, we'll try to get that loan modification. If by chance the client wants to keep their home, but the repayment plan doesn't work, the loan modification won't work, sometimes we go to Save the Dream. They don't qualify for a modification. They want to save their homes. So maybe what happens is we go to Ohio Save the Dream and we ask them for that rescue payment assistance. I'm $10,000 behind on my mortgage payment, so maybe they get the rescue payment assistance from Ohio Save the Dream and it brings them current. Maybe your client is unemployed and last 2 or 3 years now, you become unemployed and it's not like go get another job in a week or two. Sometimes it takes your clients 6 months to a year to get another job. If they're eligible, we also ask them for that mortgage payment assistance. They've been brought current with the rescue payment assistance. Now they ask them for the mortgage payment assistance to make that mortgage payment for the client until they're able to find a job. If they qualify for both of those, and if they find a job, they'll make that mortgage payment for 2 additional months after they find a job, just to make sure they're back on their feet. If your finances will allow, we can do that retention option. But like I said earlier, in some cases, no matter what happens, your finances will not allow you to stay in that home. At that point in time, we have to talk to the client about transitional options. Those transitional options are maybe, can you sell the house? And if you can sell, I mean, it's a tough market. Sometimes I can't sell the house for what I owe. I owe $125,000, and actually, the value of my home has gone down to $90,000. I can't sell it for $125,000. Nobody's going to come look at it, but I might need to sell it for $90,000. We talk about short sales, selling the house for less than what you owe. I always tell my clients, if by chance you do a short sale, just don't go out and sell it. Make sure you negotiate with that mortgage company to understand what are my ranges, how much can I sell it for? Because if you sell it for less than what they say you can sell it for, you might be eligible, you might have to pay the difference. You still might have to pay it, but we discussed your options. If I had a house on the market for 5 to 6 months and can't sell it, the mortgage company comes back to you and says, okay, we're going to sell the house now. We're going to do a sheriff sale on you. Client doesn't want to lose their house at sheriff sale, so maybe we ask for a deed in lieu of foreclosure, where can I sign the title of the house back over to you, then let me walk away. We discuss all of these options. Now, if they say yes to a deed in lieu of foreclosure, we're going to come back and tell the client, well, you know, you might want to ask for cash for keys, that transitional assistance. You know, can you give me $3,000 to $4,000 to help me move out of the house? A lot of times, if you don't ask, they don't offer. Ohio Save the Dream also has a transitional, element to it. So there are options, but the question is, what is the client's goal? What is your financial situation as well? We talked to them about their goals. We explained the options. Really, your finances, your client's finances are going to dictate what offers they're going to basically receive. The options available to each client depend on their budget. A lot of times, the banks don't have time, the mortgage companies don't have time to sit down and say, well, you need to cut this out. Let's look at your budget. Very few people have a lot of time to sit down with your clients and go over the budgets, but we do. So you send your clients to us, we'll look at the budget. And their options are based on their budget. Sometimes, if you have a very small deficit, maybe you have $100 or $200 more going out than you have coming in, maybe we can work with you to come up with ways so you can make that deficit a surplus. Maybe we can suggest some things to you. But if you have a small deficit, maybe we can look for that modification. But if you have an extreme deficit, if you've lost $20,000, $25,000 out of your household budget, which comes out to about $2,000 a month, you might not be able to save that home. So if that's the case, they may not offer you a modification. If we can, we'll go to Ohio Save the Dream and ask for funds there. If they can't do that, we look at transitional options. But that budget is very important. There are a lot of clients who come in who want to save their homes, and sometimes we can help them, sometimes we can't. So we actually do all of that. We also talk about their hardship. Their hardship and what caused them to fall behind a lot of times will determine which way we go. Tanya had talked about, we were talking about Ohio Save the Dream, but those programs are based on what your hardship is. Your clients may be sent to Ohio Save the Dream or sent to us to get those funds, but if they don't have a valid hardship, they're not eligible. So again, that's why you would send them to us. We have the expertise to direct them to the programs that may work for them, and at the end of the day, if we can't help them stay in their homes, we can help them transition out of their homes successfully. Are there any questions?
Layden, I have one for you.
Okay.
In my view, housing counselors since this whole debacle, housing counselors have been underutilized by our industry. So picture for a moment, one of my colleagues in this room shows up at a home and determines that this particular house is underwater, upside down, and all of those kinds of things. How do they initiate the conversation to get that homeowner to come and sit with a housing counselor?
It always goes back to the initial goal. When you are talking to your clients, and if they want to, if they're underwater, and if the goal is to sell the house, you're not going to be able to sell the house for what's owed on the home. So, but do you have the time to basically direct your clients into what they need to do. You know, I know you know your industry. You know what you're doing. You guys are the experts of what you do. But do you have the expertise to explain to them their options? Some of you do. But like Alex was saying, we did this 4 or 5 years ago, and there were realtors there probably from 4 or 5 years ago to now, that probably more than half of this room are new realtors. So if you're new realtors, do you know all the options you can offer your clients? If you do, fine, direct them in, you know. But when I asked the question, how many of you had sent your clients to housing counselors in the past, probably 2 or 3 people raised their hands. And we're very successful at what we do if we get your clients soon enough. The sooner you send your clients to us, the more options there are that we can offer them. But one of the reasons I asked Matt the question I asked him is, I get clients who come to me, and today is, Thursday? And they say, I got a sheriff sale on Tuesday. What can you do for me? And that happens. I know you get the same thing. Now, it happens. There's not a lot I can do. You know, I always go back to the goals. What do you want to do? What do you want to accomplish? But I can help them, maybe I can't. But if you send your clients to me soon enough, there are a lot more options. The other reason I say send them to a HUD-certified counseling agency is I know a lot of these people on this panel, and I work with them. There are things that I can do that I'm very good at, and there are things that I'm not good at. There's things, you know, sometimes they get a summons. Your clients come to you and say, I got a summons, what do I do? Well, you can send them to a HUD-certified counseling agency. I can't give legal advice, but I've got partners, you know, that I can send them to. And I know where to send them, where they're going to get good help. You know, a lot of times, you know, there are a lot of attorneys, and maybe some attorneys out here. But attorneys say, well, you know, come to me, I can help you. There's not a lot of attorneys who practice foreclosure law. Now, there are attorneys who practice bankruptcy, and they'll say, go see if you can get it worked out, and if you can't get it worked out, come to me and we can do bankruptcy. Bankruptcy is an option, but I always tell my clients bankruptcy should be the last option. There are a lot of things that you can do before bankruptcy to save your home. And if you come to a HUD-certified counseling agency soon enough, we have a lot more options that we can offer you. Good question.
Lady?
Yes, Jim. I didn't do it. Yes.
Prior to the crisis, the housing counseling agencies offered a pipeline of buyers who'd gone through budgeting classes and how to buy a home classes, and many of those classes qualified them for down payment assistance. For those realtors who worked with agencies, it was a pipeline of potential borrowers, and you know the old adage, there's plenty of homes, not enough qualified borrowers. Fast forward to 2013, in your agency, what is the status of that pipeline? Because it dropped off to 0 for a while. Now where are we on that? Can you address that?
So that if I hear this right, we also we do home buyer education counseling as well.
Right.
That's always been our bread and butter. Home buyer education has always been our bread and butter. The last couple of years, it's slowed down, but we've always had a decent flow of clients coming in for the home buyer education classes.
How many
This year,
classes a month do you offer now? Because you were doing them, I mean,
We
it was
do-
very frequent back
right,
then.
we do 2 classes a week. Well, I'm sorry, we do home buyer education classes are on Tuesdays, and we do 4 Tuesdays a month, and we do 2 Saturdays a month. And our classes range on Tuesdays, usually average about 25 to 30 home buyers in the class. And then on Saturdays, we usually have between 55 and 60 in the 2 Saturday classes. Some of you guys probably come and speak at some of those those classes.
So you're giving certificates to about 85 potential buyers a month.
Right.
Y'all should be writing this down.
I've got a question back in the back.
Yes, lady?
Yes. Yes.
I asked this question before. My yearly renewals are very commissioners. Came up with a little box for me to check.
So your question is, do we question our clients as whether or not they've participated in cash for keys?
Well, I mean, do you know of any liability whatsoever?
Any liabilities for cash for keys?
Yeah,
I-
I would say that if you had an opportunity, to tell them that they got involved in something they shouldn't have gotten involved in, you would not have said, I mean, it's cash for keys on credit rate and, considered,
Helpful to the,
The cash for keys, we bring it up because the clients we see a lot of times may have to lose their homes. And the bad thing about it, they may not have made a payment for 16 months, 2 years. And when I ask the question, okay, you haven't made that mortgage payment in 2 years, do you have any money saved? And a lot of times the client's gonna say no. So if they find themselves at the point where the sheriff's sale is coming up and, there's no options and, we're working with them, but the question is, do you have any money? They're going to be out of that house within 45 days to 2 months. And the bad thing is, they don't have any money to transition into another home. And that's a bad thing. Your clients that you sold homes to 5, 10 years ago, and they qualified 5 to 10 years ago. But we know what we just went through the last 5 to 10 years. They don't have the money a lot of times, so cash for keys helps. Cash for keys helps, but if you notice one thing, Tanya said the same thing. That transitional assistance that they have at Ohio State of the Dream is also not being utilized a lot. Now, there are guidelines now. There are guidelines that they have to show to qualify. But sometimes with cash for keys, if you're just asking for help to transition out, sometimes there are not as many guidelines when you're talking to the mortgage company, because either Fannie Mae or Freddie Mac's going to foot the bill or somebody's going to foot the bill. But again, do I know of any liabilities? I don't, but if anybody else does, please chime in.
The cash for keys is an incentive payment coming from the servicer. So there may be tax consequences to the borrower, but that's an incentive to say, hey, please don't put holes in the wall and tear out the plumbing before you leave. We will pay you to move, please keep everything nice, leave it in broom swept condition. That's cash for keys, that's really all that is.
A lot of times, if you don't ask for it, though, they won't offer it. I know you got a question. There's a question right here, and I'm going to come back to you.
For your program, is there a maximum on the homeowner's income? Is there a certain point where they're not eligible for your services?
Very good question. There are no income guidelines for us at all. We see everybody. Okay.